Hello, and welcome to 10-Minute Mastery. In this session, we will cover debits and credits. This is part 4, solving more transactions using debits and credits with T accounts. By the end of this 10-Minute Mastery, you will be able to solve transactions with the use of T accounts while applying the concept of debits and credits in accounting. Since this is part 4, let's review what we learned in parts 1, 2, and 3. We know that debit only means left, credit means right. Debits are neither good nor bad. They do not mean increase or decrease. They are neither favorable nor unfavorable. And for every debit, there must be a credit. For a T account, the left side is the debit side, while the right side is the credit side. Remember, debit all that comes in and credit all that goes out. As a real quick reminder, for assets, debits increase those, credits decrease those. For liabilities, a debit will decrease those accounts and a credit will increase those accounts. Owner's equity, debits decrease, credits increase. For expenses, a debit will increase those accounts while a credit decreases expense accounts. So let's look at even more examples in this part 4. Example 1, the business transaction reads, received cash from sales in the amount of $1,200. This business transaction impacts cash and sales. When we record this transaction using T accounts, this will be a debit to cash, which increases the cash account, while we record a credit to the sales account. The credit increases the sales account. Each account is debited or credited in the same amount for $1,200. This business transaction, as a reminder, has a debit and a credit, and it impacts 2 accounts. Example 2. The business transaction states, sold services on account to edit services in the amount of $600. The 2 accounts impacted by this business transaction are accounts receivable edit services and the sales account. For this business transaction, we will debit accounts receivable edit services, and this debit will increase this account. We will credit sales in the amount of $600, and this $600 credit will increase the sales account. Example 3, business transaction. Received cash on account from edit services in the amount of $400. This transaction impacts accounts receivable edit services and the cash account. Now, for every transaction, we know that we need a debit and a credit, which you can see here on your screen. We have a debit and a credit. And we also know that every transaction will always impact at least 2 accounts. So for this specific transaction, we will credit accounts receivable edit services in the amount of $400. This credit decreases the account. We will debit cash in the amount of $400, and this $400 debit increases the cash account. Let's look at example 4, business transaction. Paid cash to owner for personal use. We refer to this as drawing. This is in the amount of $550. The accounts that are impacted are cash and drawing. For this transaction, we are going to credit cash in the amount of $550. This decreases the cash account. We will debit the drawing account in the amount of $550. This debit will increase this drawing account. Let's look at example 5. This business transaction states, received cash from fees earned in the amount of $1,650. The two accounts we have here that are impacted are cash and fees earned. And you can see that this business transaction has both a debit and a credit entry. For this specific transaction, we will debit cash, and this will increase the cash account. And we will credit fees earned, which will also increase the fees earned account. Thank you for viewing, and feel free to leave a comment below. Also, don't forget to subscribe to my channel and give it a like.